Right now, somewhere on Wall Street, a clock is ticking. Markets are bleeding. Investors are nervous. And one metal sitting quietly in the shadows is about to do something that most people will not see coming. This is not panic. This is not noise. This is a signal. And by the time the rest of the world understands what just happened, it will already be too late. Welcome to John AG, the place where the real financial story gets told. Not the loud version, not the panicked version, but the true version. The version that actually helps you think clearly when everything around you is moving fast. Now, before we go any further, a quick word. If you are new here, and maybe someone sent you this video, or you stumbled across it while looking for answers about what is happening in the markets right now, do us one small favor. Hit that subscribe button. Think of it like this. You would not walk into a brilliant old library, read the most important book on the shelf, and then leave without asking for a membership card, would you? Of course not. So go ahead, subscribe to John AG. It costs you nothing, and it may one day save you everything. And one more thing, drop a comment below right now and tell us where in the world are you watching this from. It does not matter if you are in New York or Nairobi, London or Lahore, Tokyo or Toronto. Tell us your city, your country, your time zone. Because this story we are about to tell you today, it belongs to all of you, every single one. The morning of March 23rd, 2025 began like many mornings before it, quietly, almost deceptively so. Traders settled into their chairs, screens flickered to life, coffee cups were filled, and for a brief moment before the opening bell, there was stillness. But that stillness was not peace. It was the kind of stillness that sits just before something breaks. Because underneath the surface of the global financial market, something had already been breaking for weeks, slowly, quietly, in ways that most ordinary investors had not yet noticed, but that the data had been screaming about for some time. The numbers told a story that no headline had yet fully assembled. Major stock indices had been drifting lower, not crashing all at once, but grinding down day by day in the way that serious bear markets often begin. Not with one dramatic explosion, but with a slow and steady erosion of confidence, the kind that starts with whispers and ends with panic. At the center of this unfolding story was a geopolitical pressure point that the financial world could no longer afford to ignore. The standoff between the United States and Iran over the Strait of Hormuz, one of the most critical shipping corridors on the planet, had moved from background noise to front-page urgency. A deadline had been issued. Threats had been exchanged. And the markets, already fragile from months of inflation pressure and policy uncertainty, were now staring directly into the face of another possible shock. The Strait of Hormuz, for those unfamiliar, is not simply a line on a map. It is the single most important energy choke point in the entire world. Approximately 20 million barrels of oil pass through that narrow corridor every single day. That number represents roughly 1/5 of the world's total petroleum consumption. Alongside that, nearly 1/5 of the world's liquefied natural gas trade travels the same route. To put it plainly, if that corridor closes, even partially, the global energy market does not just feel uncomfortable, it convulses. And so, when the threat of disruption entered the conversation, markets did not wait for confirmation. They began to reprick risk immediately. Oil futures moved, shipping insurance costs climbed, and somewhere in the middle of all this noise, a quieter but far more significant shift began to take place, one that most retail investors completely missed. Silver began to move, not dramatically at first, not in the way that grabs headlines or triggers breaking news alerts. But for those who understood what silver's movement actually means inside a stressed macro environment, for those who had studied the patterns, read the history, and followed the data, that movement was deeply significant. Because silver does not lie. It does not react to rumors the way stocks do. It does not get manipulated by a single tweet or press conference talking point. When silver moves with purpose, it is usually because something structural is shifting beneath the market floor. This is the part of the story that most financial content never reaches. The mainstream conversation stays at the surface. Index points, percentage drops, political headlines, but the real intelligence lives one layer deeper. It lives in the relationship between precious metals and global risk. It lives in the gap between what the public sees and what institutional money quietly does. And it lives in the history of every major financial disruption that silver has quietly warned the world about long before the world was ready to listen. The storm of March 2025 was not yet in full force, but the signals were already there, written clearly in the data, in the energy markets, and the movement of a metal that has been telling the truth about economic stress for thousands of years. The question was simple. Was anyone paying attention? There's an old saying among veteran commodity traders, one that rarely makes it onto financial television. rarely gets quoted in mainstream investment columns, and rarely finds its way into the conversations that most ordinary people have about money. The saying is this: gold tells you that something is wrong. Silver tells you how wrong it actually is. That distinction matters enormously. And in the third week of March 2025, silver was not whispering. It was speaking with a clarity that anyone paying close attention could not afford to ignore. To understand what silver was saying, one must first understand what silver actually is. Because most people get this wrong. They think of it as simply a cheaper version of gold, a backup precious metal, something people buy when they cannot afford the real thing. That understanding is not just incomplete, it is dangerously misleading. Because silver is not one thing, it is two things simultaneously. And that dual nature is precisely what makes it such a powerful economic signal during times of stress. On one side, silver is an industrial metal. Roughly half of all silver demand globally comes not from investors or central banks, but from industry. Solar panels require it. Electronics depend on it. Medical devices use it. Electric vehicle components are built with it. This means that when industrial economies are healthy and growing, silver demand rises from the factory floor. When economies slow, that demand softens. Silver in this sense is a barometer of real-world economic activity. Not sentiment, not speculation, but actual production and growth. On the other side, silver is a safe haven asset. When investors grow fearful, when trust in paper currencies weakens, when inflation accelerates, when geopolitical tension threatens the stability of financial systems, money flows into silver just as it flows into gold. It becomes a store of value, a refuge, a way of protecting purchasing power when everything else feels unreliable. Now, here is where the story of March 2025 becomes genuinely remarkable. Both forces were activating at the same time. Industrial demand was already under pressure from slowing global manufacturing numbers, and simultaneously safe haven demand was surging as the Horm standoff, market sell-offs, and inflation concerns collided in the same narrow window of time. Silver was being pulled in two directions at once, and instead of canceling each other out, those two forces were compressing into a single explosive pressure point. The gold-silver ratio told an equally important story. This ratio, which simply measures how many ounces of silver it takes to buy 1 ounce of gold, had climbed into territory that historically precedes significant repricing events. When this ratio stretches too far, the market has a long record of correcting it, and the correction, when it comes, is rarely gentle. It tends to be sharp, fast, and deeply uncomfortable for anyone who was not positioned for it in advance. Central bank behavior added yet another layer of complexity to the picture. Major central banks around the world had been accumulating gold at a historic pace over the preceding 2 years. That accumulation does not happen in isolation. When central banks move aggressively into gold, they signal a fundamental concern about the durability of the current monetary system. And where gold leads in that environment, silver historically follows with greater velocity. Volatility in silver's price was not random noise. It was a message being transmitted in real time to anyone trained to receive it. Every spike, every dip, every sharp intraday reversal was a piece of a larger pattern. A pattern that pointed unmistakably toward a market that had not yet fully priced in what was coming. Silver had seen this before in 2008, in 2011, in 2020. Each time, the world called it a surprise. Each time, the metal had already told the truth days, sometimes weeks before the headlines caught up. March 2025 was beginning to look like another one of those moments. And this time, the signal was louder than ever before. Most people think a market meltdown looks like a single dramatic moment, a day, an hour, a number on a screen that suddenly turns red and stays red. They imagine it the way disaster movies portray catastrophe, loud, sudden, impossible to miss. But the most dangerous financial collapses in modern history did not arrive that way. They arrive the way a fault line breaks. Not all at once, but in a sequence, a chain of connected failures, each one triggering the next, each one slightly worse than the one before it, until the moment the ground itself gives way beneath everyone's feet. March 2025 was not the beginning of that sequence. It was somewhere deep inside it. And that is precisely what made it so dangerous. To understand the mechanics of what was unfolding, one must step back from the daily headlines and look at the architecture underneath. Because the meltdown accelerating through global markets in this period was not being driven by a single cause. It was being driven by three separate forces, each powerful on its own, that had collided simultaneously in a way that removed almost every traditional safety valve of the financial system normally relies on. The first force was inflation, not the transitory, manageable kind that central banks handle with a few measured rate adjustments and a steady hand. This was the stubborn, embedded kind, the kind that had already survived multiple rounds of policy tightening and was still refusing to retreat. The producer price data released just days before had confirmed what many serious analysts had suspected. Energy-sensitive categories, diesel, gasoline, jet fuel, were already climbing again before the Hormuz crisis had even fully entered the public conversation. That meant the inflationary pipeline was already pressurized. The geopolitical shock did not create the problem. It arrived into a system that was already struggling to contain one. The second force was interest rate reality. For much of the preceding year, markets had been sustained in part by the hope that central banks, particularly the United States Federal Reserve, would begin cutting rates. That hope had functioned almost like a hidden support beam inside the market structure. Investors tolerated higher valuations, accepted thinner margins, and held positions they might otherwise have abandoned, all because they believed relief was coming. By March 2025, that belief had collapsed. Rate cut odds had not merely declined. They had reversed entirely in some corners of the market, with rate hike probabilities climbing back into the conversation. When that support beam disappears, the weight it was carrying does not disappear with it. It falls. The third force was geopolitical uncertainty, and specifically the unique quality of uncertainty that the Hormuz standoff introduced. Markets can price known risks with reasonable accuracy. They struggle far more with open-ended binary risks, situations where the outcome is either manageable or catastrophic, with very little middle ground. The Strait of Hormuz presented exactly that kind of risk. Either the corridor remained open and the crisis passed, or it did not. And the consequences of the second scenario were severe enough that even a modest probability assigned to it was sufficient to reshape how institutional money behaved. And this is the detail that most retail investors missed entirely. They were watching the surface, the index numbers, the oil price headlines, the political statements. They were not watching what institutional money was actually doing beneath all of that noise. Because institutional money, the kind managed by sovereign wealth funds, large pension systems, and major hedge operations, does not react to headlines the way individual investors do. It repositions quietly. It reduces exposure methodically. It moves into defensive structures weeks before the public understands why. By mid-March 2025, that quiet repositioning was already visible to anyone reading the right data. Equity exposure in certain categories had been trimmed. Liquidity buffers had been quietly expanded, and allocations toward hard assets, commodities, precious metals, inflation-protected instruments had grown in ways that did not make the front page, but told a very clear story to those paying attention. Liquidity, perhaps the most underappreciated factor in any market crisis, was also tightening in ways that rarely get explained to general audiences. When liquidity tightens, it does not simply mean that money becomes harder to borrow. It means that the entire system of assumptions that markets run on begins to strain. Assets that were considered easy to sell become harder to exit. Bid-ask spreads widen. Volatility increases not because fundamentals changed overnight, but because the mechanical plumbing of the market is under stress. Three forces, three simultaneous failures, each one feeding the others in a loop that had no easy exit. This was not a correction. This was not a dip to be bought. This was a system under genuine structural pressure, and the most dangerous part of it had not yet arrived. History does not remember the people who panicked. It does not celebrate the ones who froze. It does not reward those who waited for certainty before they moved. Because in financial markets, by the time certainty arrives, the opportunity has already closed. What history consistently remembers, what the data repeatedly confirms across every major financial disruption of the last century, is a simple and uncomfortable truth. The people who came through strongest were not the ones who predicted everything correctly. They were the ones who understood that a decision window existed and had the discipline to act inside it before it disappeared. In March 2025, that window was open, but it would not stay open forever. The concept of a decision window is not complicated, but it is frequently misunderstood. It is not a moment of perfect clarity. It is not the point where every signal aligns and every indicator turns green, and the path forward becomes obvious to everyone simultaneously. That moment never comes. Not in real markets, not in real economies. A decision window is something far more uncomfortable than that. It is the period where the evidence is clear enough for serious thinkers to act, but where enough noise and confusion still exist that most people choose to wait instead. That gap between the serious and the hesitant is precisely where financial outcomes are determined. And in this particular window, several critical indicators were demanding attention from anyone willing to look past the surface-level chaos. The first was the behavior of the gold-silver ratio, which had now stretched into a range that had historically preceded some of the most significant precious metals repricing events of the modern era. Veteran commodity analysts understood what that stretch meant. When the ratio compresses from elevated levels, silver does not simply rise. It tends to outperform gold dramatically, sometimes by a factor of 2 or 3 during the recovery phase. That compression had not yet begun in full force as of mid-March 2025, but the conditions that historically trigger it were assembling with unusual speed and alignment. The second indicator demanding attention was the behavior of the US dollar in relation to commodity markets. Normally, a strengthening dollar puts downward pressure on commodities priced in dollars, including silver. But something unusual was beginning to emerge. Even in periods where dollar strength persisted, silver was holding ground with a stubbornness that experienced traders recognized as deeply significant. When an asset refuses to behave the way conventional relationships predict, when it holds value against a headwind that should be pushing it down, that resistance is itself a signal. It suggests that the underlying demand pressure is strong enough to override the normal mechanical relationship. It suggests that something larger is building. The third and perhaps most strategically important signal came from the behavior of mining equities, the companies that extract silver from the ground. In classic market cycles, mining stocks tend to lead the metal itself. They move earlier, they move faster, they sometimes move farther. By late March 2025, certain segments of the silver mining space were beginning to show accumulation patterns. Quiet, steady buying that did not generate headlines, but was visible in volume data to anyone tracking it carefully. Institutional money does not accumulate mining equities without reason, and the reason in this case appeared to be a fundamental reassessment of where silver's price was heading over the following 2 to 4 quarters. But the decision window carried risks on both sides, and any honest strategic analysis must address both with equal seriousness, because the danger in a moment like this is not only in ignoring the signals, the danger is equally present in overreacting to them. Blind panic and blind optimism are two different roads that lead to the same destination. Poor decisions made under emotional pressure rather than analytical clarity. The optimistic risk was straightforward. The Hormuz situation could de-escalate faster than markets expected. Diplomatic channels could open. A quiet agreement could be reached behind closed doors. And if that happened, some of the risk premium that had built up inside energy and precious metals markets would release quickly, catching those who had repositioned aggressively in the wrong direction at exactly the wrong moment. This was not a trivial possibility. Geopolitical standoffs have resolved suddenly before, and the speed of resolution can be just as shocking as the speed of escalation. The pessimistic risk, however, carried a different weight because its consequences were asymmetric. If the disruption deepened, if inflation accelerated further, if central banks remained boxed in and unable to provide the relief markets had grown accustomed to expecting, then the entities that had failed to reposition during the decision window would face a compounding series of losses across multiple asset classes simultaneously. Equities under pressure, bonds offering inadequate protection, currency purchasing power eroding, and hard assets. The very category that serious money had been quietly accumulating, moving in the opposite direction from everything else. Asymmetric risk is the concept that separates strategic financial thinking from reactive financial behavior. It asks not simply what is likely to happen, but what happens to me if I am wrong in each direction. And in March 2025, the asymmetry was not subtle. Being wrong on the cautious side was manageable. Being wrong on the complacent side was not. The serious investors, the ones whose names rarely appear in financial media, but whose decisions quietly shape the direction of markets, were not asking whether silver would move. By this point, the data had already answered that question. They were asking something more precise. They were asking how fast, how far, and through what sequence of events the move would unfold. And they were making decisions, not predictions, but actual structural decisions based on the answers their analysis was producing. Because that is the final lesson that March 2025 was teaching anyone willing to receive it. Markets do not wait for consensus. They do not pause while the majority catches up. They do not hold the door open indefinitely for those still debating whether to walk through it. The window was open, the signals were clear, and the clock was all ready.